Greetings, madam. My name is Shonna, Jite, Anak Francis, and I'm from JBA 2514B. Today, I'll be introducing a unique financial institution that made a significant mark in the banking industry, Signature Bank. So, Signature Bank was founded on May 1st, 2001 by three co-founders, Joseph J. Di Paolo, John Tamberlane, and Scott A. Shea. From its early days, the bank positioned itself as a full-service commercial bank, offering traditional services such as lending and deposit taking to a broad range of clients. What set Signature Bank apart was its strategy focused on two specialized areas, which is private client banking and commercial real estate. This niche approach allowed the bank to build strong relationships with high net worth individuals and businesses in the real estate sector. They provided tailored financial products and services that met the unique needs of these clients, which helped the bank grow steadily within this market. Unlike many traditional banks, Signature Bank was also quick to embrace the cryptocurrency industry. It became one of the most crypto-friendly banks in the US, appealing to many crypto businesses and investors. One of its most innovative contributions was Signet, a blockchain-based payment that allowed real-time 24/7 payments. This technology played a major role in attracting clients from the fast-growing digital asset sector. And that is all from me. Thank you.
Bismillahirrahmanirrahim. Assalamualaikum and good afternoon to Madam Ruziah. Okay, today I will be discussing the media's portrayal of Signature Bank collapse, a very significant event in a recent financial history. This story is very interesting. The story begins with a domino effect following the unexpected failure of Silicon Valley Bank or CVB and the prior liquidation of Silvergate Capital. Widespread panic erupted in the US banking sector, and this fear was largely fueled by concerns over banks holding the very large amounts of uninsured deposits, meaning money held beyond the standard of the insurance limit. Okay. Signature Bank, despite their diverse portfolio that include significant ties to real estate and legal industries, they also had a notable identity as crypto-friendly institution. It operated a 24/7 payment network called Signet and held up to $60.5 billion in deposit from digital current asset. And crucially, in the wake of FTX crypto exchange collapse in late 2022, Signature Bank had actually started reducing their crypto exposure, planning to cut this deposit by 8 billion. However, this proactive step was not enough to stem the tide. On Friday, 10 March 2023, widespread worry led to a massive bank run on Signature Bank. Customers, rattled by the wider market contagion, withdrew over $10 billion in a single day. This rapid withdrawal quickly led to Signature Bank's seizure by regulators that Sunday, making it the third largest bank failure in the American history. Now, that is where the media narrative becomes really interesting due to conflicting viewpoints. Okay. On one hand, one statement from regulators like the New York State Department of Financial Services or NYDFS clarified that their decision to close Signature Bank had nothing to do with crypto. They cited a significant crisis of confidence in the bank's leadership and its inability to provide reliable data during surge of withdrawals. However, a strong counter-narrative emerged, prominently voiced by Barney Frank, a board member of Signature Bank and a key figure in the past financial reforms. He repeatedly argued that there was no insolvency based on the fundamentals at Signature Bank. It means that there are no near bankruptcy. Frank claimed that regulators wanted to send a very strong anti-crypto message, portraying Signature Bank as a poster boy for a broader crackdown on the digital asset industry. Even the Blockchain Association questioned if government action improperly contribute to the collapse. Beyond these immediate events, media reports also cover ongoing investigations by the OG and SEC into Signature Bank's crypto dealings, signaling potential regulatory tightening. Post-collapse, media highlighted the US Treasury swift guarantee of all deposits, preventing wider panic and the subsequent execution of Signature by New York Community Bank Corp, which notably executed its crypto-related deposits, leaving those firms seeking new banking partners. In essence, the media painted a complex picture, a bank run full by a fear over uninsured deposits, but overlaid with a contentious debates over the actual role of crypto and regulatory intent in its downfall. Thank you, Madam.
Assalamualaikum and greeting to Madam Ruziah. I am Aresya Humairah Binti Rohaizan and I will continue to present for analysis of Signature Bank's failure, highlight prevailing liquidity risks and underlying issues. Signature Bank's collapse in March 2023 revealed a critical weakness in liquidity management despite the bank appearing financially stable. A major factor was its strong involvement with the cryptocurrency sector through its Signet platform, which facilitated a real-time transaction for crypto clients. Over 20% of its deposit came from digital asset customers. And when the crypto market entered a downturn, especially after the collapse of FTX, panic spread rapidly. Tech-savvy clients withdraw a large sums of using real-time system, draining the bank's liquidity. Another key issue was the bank's high level of uninsured deposit. About 90% of total deposit exceed the FDIC $2,050 insurance limit. These large depositors, mostly from crypto and commercial sector, acted quickly to pull out funds at the first sign of trouble. The situation worsened when the Silicon Valley Bank collapsed just 2 days earlier, causing a widespread of fear among similar clients. Even though Signature Bank had a different fundamental, panic led to a classic bank run. On top of that, Signature's risk management practices were inadequate. The bank had grown rapidly without developing strong controls to handle crises. It lacked high-quality liquid assets and didn't prepare for sudden mass withdrawals. As a result, even though the bank wasn't insolvent, it became liquid, which the bank unable to convert its asset into cash fast enough, and was shut down by regulators to preserve financial stability. Thank you.
Hello everyone, today I will be presenting on Signature Bank's strategy response during the March 2023 liquidity crisis, a situation that unfolded shortly after the collapse of Silicon Valley Bank. Okay, the first one, as the panic spread among the depositors, especially those with a large uninsured balance, Signature Bank first responded by issuing public reassurance. Executive emphasized that the bank was well capitalized and stable. However, these efforts were largely ineffective, especially given the bank's stronger tied to the crypto sector, which was already unstable after the FTX collapse. Confidence continued to fall, leading to a modern-day bank run. Okay, move to the next one. To manage the crisis, the bank turned to the emergency funding measure, including a special move from the New York Department of Financial Services allowing 14 billion in a late wire transfer. Despite this, the bank could not raise enough liquidity, and it leads to the worst financial position. Okay, the third one is the bank internal team monitor withdrawal and liquidity in a real time, focusing especially on institutional crypto and real estate client. Unfortunately, the speed and the volume of outflow overwhelmed the system. The bank also lacked sufficient high-quality liquid asset that could be quickly sold without loss. Okay, for the last one, Signature Bank coordinated with regulator, including NYDFS and FDIC, to explore rescue options like capital raise or acquisition, but no viable solution was found in a time. On 12 March 2023, regulator intervened, closing the bank under systemic risk exception to protect depositors and prevent broader panic. In a summary, despite multiple rapid strategies, Signature Bank was unable to stop the crisis. This case highlights the importance of preparedness, diversification, and fast regulatory coordination during the period of the financial stress. Thank you. That's all from my part.
4 key recommendations from Federal Deposit Insurance Corporation (FDIC) on managing liquidity risk. Firstly, liquidity risk framework. FDIC emphasized that liquidity is unavoidable in banking, so every institution must have sound liquidity risk management framework. This includes having enough financial resources to meet daily and emergency funds needs, while aligning with the funding structure with the bank overall risk profile. It is critical that the board of directors provide oversight, set the bank risk tolerance, and ensure clear responsibilities at all levels. Number 2, sector exposure. Second, bank must be cautious of overexposure to volatile industry like cryptocurrency. While this sector may offer growth, they also bring high instability. The FDIC recommend diversifying funding sources and customer base to reduce the risk of sector-specific liquidity shock. Number 3, stress testing, and contingency planning. The FDIC advised conducting regular stress testing to simulate both internal and market-wide shock. These results should feed directly to the bank contingency funding plan so the institution can respond quickly in time of stress, such as unexpected withdrawals or funding disruption. Number 4, cash flow forecasting. Accurate cash flow forecasting is essential. Bank must forecast their short, medium, and long-term liquidity need using realistic assumptions. This forecast should include both expected and contractual cash flow and must be regularly tested for accuracy to guide better decision making.
A very good day to Madam Ruziah, and my name is Axel Resa Francis. And now, I will quickly conclude our case study of Signature Bank from USA. Signature Bank's failure in 2023 was primarily driven by a rapid liquidity crisis, stemming from a massive and uninsured deposits withdrawal. This was heavily influenced by contagion widespread panic following Silicon Valley Bank's collapse, and the bank was too exposed to crypto, which made it weak against market volatility. Ultimately, poor liquidity planning could not keep up with its rapid growth, making the problems worse. From this, we learned major lessons. First, banks must prioritize robust liquidity management as it is essential for stability. Second, it is critical to diversify and de-risk, avoiding over-concentration in volatile sectors like cryptocurrency. And finally, strong oversight, both internal controls and proactive regulatory engagement, is absolutely vital to prevent such failure. So, the outcomes of this case, we saw FDIC intervention to protect depositors and prevent wider consequences, underscoring the importance of this lesson for the entire financial system. So, that's all from our group. Thank you.